Did you ever wonder how much monthly dividend income you can make from $10,000? Well, I did, and so I created some mathematical models in Google Sheets to see how well this investment into three different stocks would perform over a 10, 20, and a 30-year period. Now, the first stock we want to have a look at is Coca-Cola. So if we invested $10,000 into Coca-Cola right now, it would buy us about 144 shares. Now the current dividend yield of Coca-Cola is sitting at 2.79%. So if I plug that in, I would get a yearly income of $279, which when I divide by 12 will give me a monthly income of $23.25. And it is quite clear that this amount seems quite low from an investment of $10,000. So let's jump to scenario number 2, where we would invest $10,000 into the most popular dividend growth ETF, the Schwab US Dividend Equity ETF, or SCHD. Investing $10,000 would buy me about 118 shares at the current price of the ETF, which would, at its current yield of 3.45%, yield me about $345 yearly, and when I divide that by 12, it would be about $28.75 every single month, which isn't that much higher than the monthly income we got from Coca-Cola. But in these two scenarios, we forgot to account for one very important thing, and that is the compounding effect. For now, we will skip scenario 3, as it is a surprise to come later in the video, and we will jump straight to the future value. Now, thanks to the compounding effect, our portfolio value, including our monthly dividend, will grow over time. But by how much exactly? So first we need to plug in the dividend payout, and the dividend payout of Coca-Cola is currently sitting at $1.94. After that we need to plug in the year-over-year dividend growth, which is currently over the past 10 years sitting at about 4.83%. And finally we have to plug in the year-over-year price growth, which is sitting at about 6.18%. Now I won't be plugging in a yearly investment, as I purely want to see how much a single investment of $10,000 would yield. And finally, this model also accounts for inflation, so we have plugged in 2.3%, which is the average historical year-over-year inflation rate. Now let's finally look at what the value of our portfolio would be if you were to reinvest all the dividends you receive from Coca-Cola. So in the first 5 years, the value of our portfolio would be sitting at about $13,000. 5 years from then, so 10 years from our $10,000 investment, the value of the portfolio would be sitting at $18,000. In 20 years, the value would be sitting at about $31,000, and in 30 years, the value would be sitting over $50,000. But let's make it a little more clear. So if I scroll down to the table below, we can see that over the first 10 years, the portfolio value would grow by about $8,000. 10 years from that, so into year 20 from our initial investment, the portfolio value would have grown by $13,000. That's $4,000 higher than the first 10 years. And then into year 30, the portfolio value would grow by about $20,000. And this is a very vivid example of the compounding effect. In the first 10 years of our investment, we only made $8,000, and in the last 10 years of our investment, we made $20,000, which is $12,000 more. The compounding effect also takes place with the monthly dividend growth. So in the first 5 years, we would be making about $33 in monthly dividend income. In 15 years, we would be making about $65 every single month in dividend income, and that is enough to go out to a very nice restaurant and perhaps treat yourself to a nice meal. But if you kept reinvesting these dividends, 15 years from then, so in 30 years, you would be making about $160 every single month in dividend income. So from investing $10,000 into Coca-Cola right now, you would be making about $160 every single month in dividend income. Now in this scenario we invested into Coca-Cola, but in the second scenario we will invest into SCHD. Now the monthly dividend income over the first month doesn't seem that much different in these two companies, but let's see how the compounding effect compares. So if we jump to the future value and plug in SCHD, we will see a slight change, but now we still have to plug in the dividend payout, the year-over-year dividend growth, and the year-over-year price growth. Now the current dividend payout of SCHD is sitting at $2.93 per share per year.
So I will plug that in. The year-over-year dividend growth over the past 10 years is sitting at about 11.13, so I will go ahead and plug that in as well. And finally, the year-over-year price growth is sitting at about 12.8%, so I will plug that in as well, and we can see the graphs alter accordingly. And right away we can see that the return on our investment looks much higher than the return on our investment with Coca-Cola. So in the first 5 years, our portfolio would make about $9,000, so it would be sitting in a portfolio value of $19,000. In the first 10 years, we would be sitting at about $35,000. 10 years from that, so in 20 years, we would be sitting at $119,000. So in 20 years, we would have made twice as much investing $10,000 into SCHD than investing it into Coca-Cola. And finally, 10 years from then, so in 30 years' time, our portfolio value would be sitting over $380,000.
Now the dividends compound as well. So in the first 5 years, you would make about $2,000 in passive income. In the first 15 years, you would make about $13,000 in dividend passive income. And in 30 years, $75,686 in passive dividend income. The monthly dividend would compound as well. So in the first 5 years, you'd be making about $56 every single month in passive dividend income. And in 30 years, you'd be making $1,320 in passive monthly income, which would most probably be enough to pay for most of your bills.
Now, if you are as curious as me, you have had to wonder at some point how much a high-yielding dividend stock such as TSLY would return on your investment. TSLY is a real ETF that has a dividend yield of almost 90%. Now, normally ETFs with such a high dividend yield have a negative year-over-year price growth and negative year-over-year dividend growth. And so if we invested $10,000 into TSLY right now, it would buy us about 817 shares, which would give us a yearly income of $8,920 or a monthly income of $743. Now, normally such companies don't last very long as they go bankrupt, but let's pretend TSLY would last for 30 years and they would keep their dividend yield of 89.20%. So let's jump to our TSLY future value. So right away we can see that the dividend payout of the company is sitting at $2.93 per share per year. And the year-over-year dividend growth is sitting at negative 30.58%, and the year-over-year price growth is sitting at negative 25%. So if we have a look at the monthly dividend income, in the first year we would be making about $195 in dividends every single month. Now only 5 years after that, we would be making only $114 in monthly income. 15 years from our $10,000 investment, we would only be making $14 a month, and in 30 years, we would be making 26 cents every single month. Now, if we have a quick look at the dividend graph to the right, we can see that in 20 years, we would have made about $14,000 in dividends. But thanks to the year-over-year decreasing price growth of the company, our portfolio value would still keep decreasing and would be at a value of about $36 in the time of 30 years. And yes, you would make about $14,500 in dividends in those 30 years, but as you have reinvested them into the portfolio over the 30-year period, the value of your overall investment would be $36. So you would go from about $10,000 in year 1 to $36 in year 30, which shows that an investment into a high-yielding non-dividend growth stock is not at all profitable. You should rather invest into SCHD, and if you are to invest $10,000 into SCHD right now, in a 30 years time, you would have $380,000. Now say you wouldn't only make an initial investment into this ETF, but you would also invest $5,000 every single year. And if we plug that in, you can see that in 30 years, your portfolio value would be sitting at $1.6 million.
Now regarding the monthly dividend income, you would be making about $5,500 every single month, which is about $67,000 yearly. Now that is quite higher than the average salary in the US. So yes, it is quite possible to live from an investment of $10,000 and a yearly investment of $5,000 if you invest into a good ETF. If you want to download these sheets, and test out ETFs or stocks you yourself are interested in, you can do so for free at my Patreon in the link in the description.
And with that, if you did enjoy the video, make sure to leave a like and let me know down in the comments into which ETF or into which stock you would invest $10,000.